All right, welcome back to the Capital Breakdown, where we take the mystery out of money and put you in the driver's seat of your financial journey. Today, we're tackling a classic newbie question. If you have just $1,000, what's the safer place for it? Should you park that cash in an emergency fund or jump straight into investing? It's a question that feels simple, but actually touches the core of smart money management, balancing safety and growth. Is it better to have quick access to money for surprises or to start building wealth early? We're breaking this down with clear, practical thinking, no hype, no promise of quick riches, just solid info to help you shape your plan. So stick around, because by the end of this episode, you'll see why an emergency fund often deserves top billing before investing, and how to think about both as parts of a bigger financial picture. Let's start by defining an emergency fund. Think of it as your financial safety net, a stash of cash set aside for unexpected expenses like a car repair, medical bill, or sudden loss of income. This isn't money for a weekend trip or new gadget. It's your buffer against life's curveballs. The usual advice is to save 3 to 6 months' worth of essential living expenses. That can sound like a lot, but having this fund reduces stress and keeps you from falling into debt when emergencies hit. For example, if your rent, food, utilities, and transportation cost $2,000 a month, you'd want between $6,000 and $12,000 saved to cover those basics. That way, if you lose your job or face a medical emergency, you have time to adjust without panic selling or borrowing at high interest. Investing, on the other hand, means putting money into assets like stocks or bonds, hoping to grow it over time. But, and this is key, investing involves risk. Your money can go up or down, sometimes quite sharply. Unlike an emergency fund, invested money isn't guaranteed to be there when you need it. Picture your emergency fund as a sturdy lifeboat, always afloat, while investments are your sailboat, potential for speed and growth, but not guaranteed to stay steady in choppy waters. So why not skip the emergency fund and start investing right away? After all, markets trend upward over the long term, and investing can grow your money faster than a savings account. But here's the catch. Markets can dip suddenly. Imagine you invest your $1,000 and then face a $500 car repair the next month. You might have to sell investments at a loss just to cover that bill. The emergency fund acts like a fire extinguisher, ready to douse emergencies without forcing you to sell at the worst time. By securing a cash cushion first, you avoid tapping into investments prematurely, which helps keep your long-term growth intact. It's like having a backup battery for your phone. You want that reserve power before pushing the system hard. Plus, without cash on hand, you might resort to high-interest credit cards or loans, which can drain your finances faster than any market dip. Where to keep your emergency fund? Since you might need it quickly, safety and liquidity are key. Most go with a traditional savings or money market account. These offer easy access and virtually zero risk of losing principal, so interest is low, sometimes barely outpacing inflation. Think of parking your car in a safe garage instead of a flashy downtown spot. It's not glamorous or fast-growing, but it's secure and ready when you need it. Some consider high-yield savings accounts or short-term certificates of deposit, CDs. Those can earn a bit more but might limit quick access. For example, a CD might lock your money for 6 months or a year, with penalties for early withdrawal. The key is balancing safety, liquidity, and some growth, without chasing high returns in your emergency stash. Remember, the goal isn't to make money here, but to protect it and have it available on demand. Let's zoom out. Emergency funds and investing aren't forever either-or choices. They're parts of the financial roadmap that changes as your life evolves. Early on, the priority is building a foundation of security. Once you've saved a small, manageable emergency fund, say $1,000 to $2,000, you can start dipping a toe into investing. That's when you let your money work for you, riding the power of compound growth over years and decades. Compound growth is the magic of earning returns on your returns, like a snowball rolling downhill, growing bigger as it goes. Even seasoned investors keep some cash reserves because life doesn't wait for market timing. This layered approach, secure first, grow second, balances peace of mind with financial progress. It's like building a house. You lay the foundation solid before adding walls and roof. Without a strong base, the structure can crumble under stress. What about risk tolerance? It's your personal feel for how much uncertainty you can handle without losing sleep. If the idea of your savings dipping stresses you out, prioritize a solid emergency fund. If you can stomach market ups and downs, starting to invest earlier, even with a smaller emergency cushion, might feel right. But investing without a safety net can mean selling at a loss during tough times, a heavy psychological and financial hit. For example, during the 2008 financial crisis or the 2020 pandemic crash, investors without cash reserves may have been forced to liquidate at low prices, locking in losses. So, risk tolerance is about more than numbers. It's about your comfort and ability to stay the course. Think of it like riding a roller coaster. Some enjoy the thrill, others prefer a smooth ride. Knowing your preference helps you make decisions that keep you calm and consistent. Another key piece, your time horizon. An emergency fund is for short-term needs, cash you can access within days or weeks. Investments, especially stocks or equity funds, suit longer horizons. Think 5 years or more. Why? Because markets can be volatile short-term, but tend to smooth out over time. For example, saving for a house down payment in 2 years means keeping money safe and liquid. But saving for retirement 30 years away lets you ride out market dips and benefit from growth. If you might need money within months, keep it liquid and secure. For retirement or big purchases years away, investing offers growth potential. Matching money's destination with timeline is smart. It's like packing for a trip. Short-term, you want convenience and quick access. Long-term, durable gear that lasts. Now, diversification, not just in investing, but your financial safety plan. An emergency fund diversifies your financial risk by having accessible cash. When investing, diversification means spreading money across assets, stocks, bonds, real estate funds to reduce risk. But this only works if your emergency fund is in place. Think of it as building a sturdy base before stacking blocks. Without that base, investing can feel like a house of cards, vulnerable to shocks. The Capital Breakdown encourages you to think holistically. Your financial health isn't just how much you invest, but how you protect yourself. For example, owning just one company's stock risks big loss if it falters. But a diversified fund with thousands of companies and bonds spreads risk. Similarly, your emergency fund spreads risk by providing a cushion separate from investments. Time for real-world examples. Sarah just started her first job and saved $1,000. She debates investing in a broad stock market index fund or keeping it as an emergency fund. 1 month later, her car needs a $600 repair. Because she has that emergency fund, she pays without stress. If she'd invested the $1,000 instead, she might have been forced to sell shares during a market dip, losing principal. Mark has a $5,000 emergency fund already, so he feels comfortable investing an extra $1,000 in a diversified ETF. His emergency cash gives him confidence to ride market ups and downs long-term. These examples show how starting with safety empowers investing decisions. Another, Lisa earns irregular freelance income. She keeps a larger emergency fund, about 6 months of expenses, because income varies, with that safety net. She invests steadily, without worrying about short-term cash flow. These cases highlight how context shapes the best approach. What if you're dealing with debt or irregular income? If you have high-interest debt, like credit cards, it usually makes sense to pay those down before investing heavily. That's because interests you pay can outweigh investment gains. For example, if your card charges 18% interest but your investments average 7%, paying down debt saves more money. Similarly, if income fluctuates monthly, a larger emergency fund smooths cash flow bumps. Then you're not forced to borrow or sell investments at bad times. Think of your emergency fund as a shock absorber on a bumpy road, cushioning the ride so you stay on track without derailing. This shows how personal circumstances shape the saving versus investing priority. A gig worker with irregular paychecks might need a bigger emergency cushion than someone with a steady salary. Your plan should reflect your unique situation, not just textbook advice. Okay, practical time. How do you start building an emergency fund if you're living paycheck to paycheck? Small, consistent steps win the race. Maybe set aside $25 or $50 a week. Automate transfers to a separate savings account. It's like paying yourself first. Even if money feels tight, treating savings like a non-negotiable bill builds momentum. Avoid dipping into this fund for non-emergencies by mentally labeling it "Do Not Touch." Picture it as your financial lifeboat, there for genuine emergencies only. One trick: keep the emergency fund in an account easy to access, but not your daily checking, so you're less tempted to spend it. Once you hit an initial target, say $1,000, you can start exploring investing with small amounts in low-cost index funds or ETFs. Many platforms let you invest with just $50 or $100, making it accessible. This balances safety with growth potential. Building wealth isn't a sprint, it's a steady marathon with deliberate steps. When you start investing, remember it's a long game. Markets go up and down, sometimes sharply. Diversified investments help manage volatility, but it can still feel nerve-wracking without a solid emergency fund underneath. So don't rush. Build your emergency fund first, then add investing in increments that feel comfortable. Always keep some cash liquid, maybe 1 or 2 months of expenses, on top of your core emergency fund. This layered liquidity strategy gives flexibility without sacrificing growth. It's like having safety nets at different heights, catching you if you fall. For example, you might keep $3,000 in an emergency fund, $1,000 in checking for immediate bills, then invest steadily in retirement or brokerage accounts. This helps avoid panic selling during dips and keeps your financial path steady. Also, review your plan as life changes, marriage, job shifts, kids, to stay on track. Before we wrap, a quick reminder: this episode is educational only, not personal financial advice. Your best moves depend on your unique situation, goals, and comfort with risk. Do your own research, keep learning, and consider chatting with a qualified financial professional to tailor a plan for you. Emergency funds and investing aren't opposing forces, but teammates on the field of financial wellness. Start with safety, build steadily, and watch your confidence and your money grow. The path to financial security isn't about rushing to get rich fast. It's about making consistent, thoughtful decisions that build resilience and opportunity over time. Thanks for joining the Capital Breakdown today. Here's to making smart, steady progress with your first dollars and beyond. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.